The U.S. national debt grows by roughly $4.25 million every minute. Yeah, you read that right. Every single minute. It's almost too crazy to wrap your head around. But here's the thing that keeps me up at night. What happens when the music stops? Picture this. You wake up tomorrow morning, grab your coffee, check the news, and discover that the safest investment in the entire world just became radioactive overnight. Over the next few minutes, I'm walking you through exactly what the first day of an American debt default would look like. Not some vague economic theory. I mean the actual minute-by-minute chain of events that could turn a political stalemate in Washington into a global financial nightmare. And yeah, this affects your wallet, your retirement, your family's future. Let's start with the basics. A U.S. debt default happens when the government misses a payment it owes. Simple as that. Except imagine missing a credit card payment, then multiply the consequences by about 1 trillion. Here's how the system normally works. The government pays its bills by selling Treasury securities, bonds, bills, notes, whatever you want to call them. For generations, these things have been considered bulletproof. They're the foundation that holds up everything from your grandmother's pension to the Bank of Japan's reserves. A default would crack that foundation instantly. So how do we actually get to that point? Most likely scenario? A political train wreck over the debt ceiling. Now, the debt ceiling gets misunderstood all the time. It's not about approving new spending. Congress already did that when they passed the budget. The debt ceiling is about borrowing money to pay for stuff we already bought. Military paychecks, highway repairs, Social Security checks, Medicare bills. All of it already approved, already spent. When Congress plays chicken with the debt ceiling and refuses to raise it, the Treasury Department has to get creative. They've got incoming tax revenue and some accounting maneuvers, they call them extraordinary measures, to buy time. But eventually, those run out. That's when the Treasury faces an impossible choice: who gets paid and who gets stiffed. The second they can't cover everyone, particularly when they miss a payment to someone holding a Treasury bond, that's default. Something that's literally never happened in modern U.S. history, and it would trigger an immediate financial catastrophe. A default doesn't announce itself with fireworks. It starts silently, buried in the Treasury's computer systems. Somewhere in that network, a scheduled payment fails to process. Maybe it's owed to a German bank, maybe a California pension fund, maybe just some retiree in Florida who bought savings bonds decades ago. For a few minutes, nobody realizes what's happened. Then the press release hits. The Treasury Department, in the driest possible language, confirms what seemed impossible. The United States of America has failed to pay its debts. Within seconds, and I mean seconds, the credit rating agencies make their move. Moody's, S&P, Fitch, they've been threatening this for weeks, and now they pull the trigger. America's credit rating gets slashed. For the first time in history, U.S. debt isn't considered risk-free anymore. It might even get tagged with selective default status. This sounds like just paperwork, right? It's not. It's like removing the bottom piece from a tower of blocks. Investment contracts all over the planet have clauses that say we can only hold the safest securities. Suddenly, thousands of institutional investors are legally obligated to dump their Treasury holdings. Massive selling pressure, and nobody wants to buy. Meanwhile, the government's payment infrastructure starts seizing up. Can't borrow, cash reserves are gone, so the Treasury just stops paying. Social Security deposits that should have hit bank accounts this morning? Frozen. Federal employee paychecks? Frozen. Military salaries? Frozen. State Medicaid funding? Gone. For tens of millions of Americans, this just became very, very real. Morning breaks in Tokyo and the markets open to absolute chaos. The Nikkei crashes so hard it triggers automatic circuit breakers. Trading just stops. Same story in Hong Kong, Seoul, Australia. These aren't random panic attacks. Asian economies are deeply interconnected with the US. Their exports depend on American consumers. Their central banks are sitting on mountains of US Treasury bonds. When America's creditworthiness collapses, their entire financial foundation shakes. As the crisis rolls westward, the dollar starts falling off a cliff. Currency traders are selling dollars as fast as they can click their mice. The world's reserve currency is suddenly looking fragile, and that sends everything priced in dollars, oil, gold, commodities, rocketing upward as people scramble for safety. By the time European markets open, we're looking at a full-blown systemic meltdown. London and Frankfurt see the same bloodbath, but there's an even deeper problem here. European banks use U.S. treasuries as collateral for the trillions they lend each other overnight. That collateral just became worthless. The interbank lending market, basically the circulatory system of global finance, freezes. Banks stop trusting each other. They stop lending. Everyone's terrified that everyone else might be insolvent. Back in the States, it's still dark, but the futures markets are screaming. These early indicators are pointing to a catastrophic drop when U.S. markets open. Some analysts have thrown out numbers like a 30% stock market plunge. Red lights are flashing everywhere. What started as a political gamble has morphed into a genuine global crisis. The world's safest asset just became its biggest liability. This is when it stops being about charts and percentages and starts hitting your actual life. The New York Stock Exchange opens and it's carnage. Markets plunge so fast they trigger the highest level circuit breakers. Trading halts for the entire day. But it's too late. In those first few minutes, trillions in household wealth just evaporated. Your 401k? Down. Your IRA? Crushed. Your kid's college fund? Take a big hit. Then comes something truly scary. Money market funds start breaking the buck. These are supposed to be as safe as cash, always worth exactly $1 per share, but they're loaded with short-term government debt that's now in default, and their value starts dropping. Cue the panic. Millions of people and businesses try to pull their money out simultaneously. A classic bank run, except it's happening to a $5 trillion chunk of the financial system. You decide to hit the ATM and grab some cash, just to be safe. You're not alone. Lines stretch around the block. Pretty soon, the machines run dry. Banks, watching their own treasury holdings turn to dust, start limiting withdrawals to avoid collapse. Then things get really weird. You head to the grocery store, swipe your credit card, declined. Try the debit card, also declined. The invisible machinery that processes millions of transactions every second, it's all breaking down. These systems depend on banks functioning normally and money flowing freely. That system just shattered. Meanwhile, government operations grind to a halt. TSA agents might not show up. Air traffic controllers could walk off the job. Flights get grounded. Mail delivery slows to nothing. And for the roughly 50 million Americans who depend on Social Security, those delayed checks mean they can't pay rent, can't buy medicine, can't keep the lights on. About 2/3 of seniors rely on Social Security for at least half their income. For many, it's basically everything. This isn't an economic crisis for them. It's an existential threat. The abstract idea of default has transformed into empty ATMs, locked bank accounts, and real fear spreading across the country. The economy isn't just in recession, it's paralyzed. As day one draws to a close, the initial panic gives way to something worse, grim realization. The United States can't borrow money, not at high interest rates, not at any rate. Capital markets are completely shut to us, which means the government has zero ability to fight the depression it just created. No unemployment benefits for the millions about to lose their jobs. No stimulus package to restart the economy. Nothing. Emergency meetings are happening everywhere. G7, UN, IMF. There's a genuine leadership vacuum. For 75 plus years, the global economy ran on US dollars and the safety of US debt. That's gone now. World leaders are trying to answer an unanswerable question. What comes next? Is the euro the new reserve currency? The Chinese yuan? There's no obvious replacement, and that uncertainty just piles more chaos onto an already unstable situation. The long-term picture is starting to come into focus, and it's ugly. This isn't a temporary shock. It's a fundamental restructuring of how global finance works. Economists have stopped using the word recession. They're saying depression now. Those scary projections about 8 million job losses and unemployment over 8%, they're starting to look optimistic. The trust America built over centuries, gone in 24 hours. The country's role as the global economic anchor has ended. not because of war or natural disaster, but because of a completely self-inflicted wound. As the first day closes, everyone's staring at a future where borrowing costs more for everybody, where the engine of global growth has seized up, where a long, painful economic winter is just beginning. The question isn't how to fix this anymore, it's how to survive it. Look, this 24-hour timeline is terrifying. I get it. But here's the crucial part. None of this has to happen. A U.S. debt default wouldn't occur because we're broke, it would happen because politicians failed to do their job. The solution, Congress raising the debt ceiling to pay for things they already approved, is sitting right there. It's not complicated. The debate about government spending and the national debt, that's important. That's a conversation we absolutely need to have with legitimate arguments on all sides. But threatening the full faith and credit of the United States as a negotiating tactic, that's playing with matches in a fireworks factory. What part of this scenario worries you most? Drop your thoughts in the comments. And if you want to understand how we built up this massive debt in the first place, check out our next video on that topic.